Good day, ladies and gentlemen, and thank you for standing by. Welcome to our event today, Economic Market Update. During today's presentation, participants will be in a listen-only mode. To ask a question at any time throughout today's presentation, please do so by typing your question in the Q&A box located in the lower right side of your screen. Please be sure to submit your questions to all panelists. If you have issues with the WebEx platform, please contact WebEx Technical Support at 1-866-229-3239. As a reminder, this presentation is being recorded. I would now like to turn the call over for us to get started.
Hello, everyone. Thank you for attending today's webinar, the Corelogic Economic Market Update. My name is Brian Fleur. I am the Director of Product Marketing at Corelogic, where we provide consumer, financial, and property information, analytics, and services to both the business and government sectors. I'm very pleased that you have taken the time to join us today, and I assure you this is going to be time well spent. We have a lot of great data, insight, and analytics to share with you, and most of that data comes from a very powerful Corelogic product called the Real Estate Analytics Suite. If you're looking for real estate data, this suite has what you need, including home price trends and forecasts, a valuation engine that provides the estimated value on a single property or multiple properties, listing trends, which includes data derived from our MLS and listing data partners, and commercial trends, which pulls data from our industry-leading non-securitized property database. Now, Tara Bleakley, the product manager for the Real Estate Analytics Suite, is on this webinar today, so if you have any questions about this suite, go right ahead and ask, and she'll be there to respond. I also recommend you visit the website to learn more, but of course, only do that after the webinar, because we have a lot in store for you starting right now. Today's presentation is going to focus on what's on a lot of our minds, and that's the current real estate economic conditions and economic outlook for 2012. Throughout this webinar, I encourage you to ask questions, and you can do so by just typing in the box at the bottom right, and as a reminder, this will be recorded. So, now let's get on with this webinar. It's my great pleasure to introduce today's speaker, Dr. Mark Fleming, Corelogic's chief economist. Now, what a great title he has, and he has indeed earned it. Dr. Fleming received both his master's and doctorate from the University of Maryland. Before joining Corelogic, he worked at Fannie Mae, developing property valuation models, and Dr. Fleming is responsible for developing the collateral risk, valuation cascade, and housing price index models, as well as the economic analysis and monitoring of real estate and mortgage market trends. In his critical role within our company, Dr. Fleming brings more than 10 years of experience within the mortgage and property information space. Mark is one of the most sought-after individuals at Corelogic and our industry. He's often quoted in trade publications and national news outlets. It's great to have him here with me and with you today. So without further ado, I now introduce our featured presenter, Dr. Mark Fleming.
Thank you, Brian, and thank you, everyone, for attending today. Look forward to hopefully this being a very informative hour for everybody. The title of the presentation is Recovery in Moderation and Economic Temperance Movement, and that's in part because I feel like in some ways we've had some growth abstinence over the last couple of years. It's been certainly economically, over the 2 or 3 last years, a slow go of things in the housing market. We're probably into year 5 or 6 of it. That being said, there's certainly some good things for us to talk about today and some positive things to talk about for the future for the housing market especially. Well, so let's talk about, to begin with, obviously economic growth. And the headline way to talk about economic growth is GDP. This is real annualized quarterly GDP growth. Basically, the blue lines show you the negative lines pointing down are recession. The lines above the zero line pointing up indicate that we're growing economically, and you can see the Great Recession in 2008, 9, and early 2010 had some very significant declines. In fact, at one point, we were contracting at over an 8% annualized rate. Since then, actually, we've had some reasonable returns. They've been going on now for a couple of years in terms of growth. The big issue, though, is what is the long-term level of growth? There's a period called the Great Moderation. That's basically from after World War II through to current, and we averaged a growth rate of roughly long-term of 3.25%. And most analysis or most economists would say that when you have a recession, the key coming out of the recession is to bounce back with what they refer to as above-trend growth. And it's been we haven't had very much above-trend growth if we conclude that the growth rate of the long-term trend of growth is 3.25%. But there's actually mounting evidence in the economy of the last couple of decades that as the economy has transitioned from a more manufacturing to a services-based economy, that the long-term growth rate is not actually any longer 3.25%, but something more on the order of 2 to 2.5%. And if you consider that long-term growth rate of 2.5%, you can see that we've actually been in 2010 above trend, and in 2011, in the last quarter at least, above trend, and probably into 2012, right around trend. We've just revised the Q1 GDP numbers to 2.2%. Then Q4 was, its final number was 3%. So Q4 is slightly above trend. Now we're running a little bit below if we assume that 2.5 rate. And so what we're going to talk about now is the next few slides is some of this reason why we believe that long-term growth rate has changed and what that means for the economy and labor markets. Let's actually take a look at labor markets because for most of us on the phone, it's really more obvious and more personal to us is this idea of having jobs. And of course, most people who have mortgages pay for their mortgages using their income, so you have to have a job for that. If you look historically during the recession in 08 and 09, you can see we were laying off large numbers of people. In fact, we peaked at a rate of 750,000 layoffs a month at the height of the recession. So there was a significant contraction in the labor force. Since then, we have had growth in labor. We have been creating jobs. The real problem has been that it hasn't been enough, or many have argued that it's not enough job creation. You need intrinsically 125 to maybe tops 150,000 jobs to be created just to absorb new entrants, those who are graduating from college, who are entering the labor force in their various capacities, and we clearly haven't had enough. And then you'd need incremental job creation above that to actually lower the unemployment rate. And we see that we haven't actually had much of that in terms of job creation. That being said, we did have a pretty good run late last year and into this year of job numbers. We did post 1 month at 200,000 at the very beginning of this year. The March data looked a little bit weaker in terms of job creation, and early indications. Yesterday, ADP reported a lackluster early number on jobs, and tomorrow the government will report its monthly information with the job creation numbers and the unemployment rate. So we're looking at saying it might be a little bit weaker than we were hoping for, and that's why we're sort of characterizing much of the growth that we're seeing in 2012. We got off to a strong start both economically and in the labor markets, but now it's fading a little bit. It's not necessarily fading to the steady state or stall speeds that we saw in the middle of last year, but certainly a slowdown in the pace of growth to probably just below trend. Digging a little bit deeper into the unemployment rate and the labor markets, we want to talk a little bit here about an economic law called Okun's Law. Not necessarily as robust as Einstein's theory of relativity and physical laws, but this economic Okun's Law was something that basically says for every 2% above long-term trend growth, you would get a 1% reduction in the unemployment rate. Now, we've seen actually a roughly 1% reduction in the unemployment rate over the last year, but that's actually been in the context of only barely above growth if you assume 2.5 long-term trend, and certainly below growth in 2011 if you were to assume the higher 3.25% trend rate. So how is it possible that the unemployment rate is going down with not an insufficient amount of above-trend growth? In other words, is Okun's Law finally broken? This is an economic theory that's been out there for probably 50 years now. The reason is that Okun assumed that all else would be held equal. In other words, in particular, the labor force participation rate would remain constant. The reason he assumed this, and it was actually a relatively good assumption in the industrial American economy, was that labor was considered to be a quasi-fixed factor of production. In economics, we talk about 3 factors of production: land, labor, and capital. And for much of post-World War II industrial America, with a higher prevalence of unionization and manufacturing-based work, the labor force was quasi-fixed. That meant that people generally didn't get laid off, except in extreme events, and were more quickly rehired, and so participation in the labor force was much more stable. You can see here the red line shows that the labor force participation rate over the last few years has declined very precipitously. So the gains in the unemployment rate that we're seeing over this past year are not necessarily gains due to job creation as much as they are gains due to a reduction in people participating in the labor force. Now that might sound like a very negative statement, and there's certainly some concerns about long-term economic success of this country related to that idea of less people participating in the labor force. We believe in America that this is a good thing to have a job and participate and be a productive member of society, but there are some silver linings, and that is, for example, the 18 to 24-year-old age category is going to college at the highest level share of college people we've ever seen historically. So there's a retooling, if you will, of people in terms of getting education for the long run that we might see this labor force participation rate pick back up again. Obviously, part of that has to do with the health of the labor markets, and as job creation grows and strengthens, obviously that would encourage people to return to the labor force. So Okun's law is not necessarily broken. It's just that one of the assumptions of the labor market staying fixed or people remaining in the labor market has changed in this particular recession. One of the other concepts around the fact that of the labor force participation rate was that productivity always used to be a pro-cyclical event. In other words, because of the quasi-fixed nature of labor and productivity basically measuring total output divided by the number of people who were used to make it, that if you, as the output went down during a recession, you'd have less demand and less output being created, the GDP would decline. Because you weren't laying people off, the productivity would rise because would fall because you're making less with the same amount of people. And then as demand returned and GDP began to grow, given that same group of people, productivity would rise again. This time it's very different in part because obviously productivity is a function of the GDP and the labor force participation rate, which is changing. So we don't know nowadays when we look at this chart, for example, there seems to be much less of a correlation, either pro or counter-cyclical, of productivity to the labor force, or as measured by the unemployment rate anymore. And in fact, what we've noted in our most recent recessions since 1990 is that productivity actually spikes significantly coming out of a recession to accommodate GDP without any particular increase in job creation and sort of in a reduction in the unemployment rate. And that's actually because, remember those three factors of production, you have labor, capital, and land. And what's actually happened in our more modern economy as we've moved away from the industrialized American complex of the 50s, 60s, and 70s and more recently to a more service-based economy or less industrial-based economy, let's say at least, that it's the substitutability of capital and labor is much easier right now. So, for example, we increase productivity through capital spending, and we buy computers and technology and create more efficient processes and do Six Sigma processes, business process improvement things coming out of a recession. We do lots of things to be able to increase our productivity given a certain amount of labor force by basically applying more capital in the form of computers. This is really a fundamental shift in our economy away from that industrialized economy to the more modern economy where capital plays a more important role in production or the creation of economic growth than relative to labor than in times past. And you see this through the breakdown in the counter or pro-cyclicality of productivity these days. So that's why we talk about this as not being your mother's economy. In this chart, we take the labor markets and we take each one's peak labor point for each of these recessions since post-World War II, and we say how many jobs were laid off in terms of percentage terms, So most of these recessions laid off anywhere from 2 to 4, 5%. And how many months it took to do it? So they were pretty fast. It took about a year for the contraction in the labor market to occur. And then in most cases, you see these sharp increases in return of all these people back to that full employment or sort of replacing or rehiring all the people that you laid off. And it only would take another 6 to 8 months to do that. So you have these strong V-shaped recoveries, but if you look carefully at the color coding of those recoveries, they're all in the classic industrial decades of post-World War II America, the 40s, 50s, 60s, and 70s. Of course, the most recent recession, the red line, we certainly lost a lot more jobs than any other recession has had, so that's why it's referred to as the Great Recession. And it has taken longer to do it. It's about a 2-year cycle through to the trough that we had in terms of percent of job losses, but also a much slower upward trend. You're not getting these V-shaped recoveries like we used to do in industrial America. And if you look at the last 3 recessions, the most recent one, the brown line that represents the 2001 recession, which was milder, but also similarly timed, and the black one, which is the 1990 recession, again, even milder, they all have more of that U-shaped recovery profile to the labor markets. And that's because since 1990, we've had a much more ability to substitute capital for labor in a recovering economy, and so labor markets don't respond in our modern economy nearly as quickly to growing GDP as they used to in a more industrialized economic base. So I suppose the point here is that this is more of a new normal, right? It will take a long time to reduce the unemployment rate because of the way our economy is now structured. Less industrial, more service-based, and more ability to substitute capital for labor. And that means you rarely rehire individuals back to the same jobs that you laid off, which is really what was happening in the 50s and 60s. People were laid off from the manufacturing line. When demand returned, they'd go back to that same manufacturing line. But in a modern economy, job layoffs are much more permanent. These jobs are removed that aren't really coming back. And so there's a retooling of the labor force that has to happen. Of course, that stretches out the timelines for recovery for people to basically take new kinds of jobs rather than the return of the old jobs as the economy effectively reinvents itself coming out of each recession.
Dr. Fleming, we have a couple of questions that have been coming through. Can we take a second and go through a couple of those?
Yeah.
Okay. One question we have here is somebody must have stopped and filled up with gas on the way in to attend this webinar, and it is, are oil prices a significant problem for economic growth?
That's a good question, certainly timely considering the price of gas at the moment. It's not fair to say that they are not a problem. They certainly present a drag on economic growth. Obviously, as people have to pay more for gas, usually their ability to respond to increasing gas prices in terms of changing where they work or where they live and materially changing their demand for gas is relatively inflexible or inelastic. And so they end up having to, in the short run, year or two, whatever, short run meaning year or two, have to actually pay more, and that usually comes out of discretionary or disposable income, and that means consumer spending is slowed down. So yes, there's a economic impact of higher gas prices. Is it large economically? Most of the analysis says no, it's 0.1% on growth, not full percentage points. But more importantly, I think something that we have to remember is that our economy itself is actually becoming less and less reliant on energy. We are the most efficient we've been in 40 years as an economy in terms of how much energy, gas, electricity, heating oil, whatever else we use, more and more efficient than we've ever been in terms of generating the economic output. Even as our economic output has grown, our actual demand for energy, largely in the form of oil and coal, has declined. So we've been able to do more with less, and more efficient cars and things like that have all helped to lessen the economic impact of changes in things like gas prices. So yes, it has an impactful effect, but it's less and less strong as we become a more efficient user of energy in this economy.
Do we need our account number and domain?
Perfect. Let's take one more. What will the impact of not extending the temporary tax cuts be?
Right. So that to me is a much more important issue today than $4 gas. The tax cuts represent $280 billion that would basically, if we don't extend them at the end of the year, that would have to be paid in 2013. $280 billion has to come from somewhere in everyone's pocketbooks, and so it would have a significant impact on consumer spending, obviously. Most are estimating that is in terms of percentage impact on GDP of about 1.8%. So that's very, very significant. We're actually facing what many are referring to now as a fiscal cliff at the end of this year, because not only are the tax cuts set to expire, the long-term unemployment payroll tax vacation and the extension of unemployment benefits are also set to expire, and the sequestration from the budget spending debate is set to kick in with a spending contraction in 2013 if something is not done this year. And so while we are a number of months away from that fiscal cliff, these things in total do represent a significant contractionary influence on the economy. Obviously, there's time politically and economically for everyone to address these issues. So what's not clear is how much or how little of that fiscal cliff will be addressed before that election, before the end of the year, certainly in light of the election also happening. But that, to me, is probably one of the largest factors that has to be addressed in terms of the future health of the U.S. economy today.
Well, great. Let's continue on, and we'll get to some more questions a little later in the webinar.
Okay. We'll turn our attention to mortgage performance. Classically, what we want to focus on, obviously, is the serious delinquency rate. This is the 90-plus days, so everyone who's 3 months more or later in foreclosure or REO. Blue line peaked at a little over 8%. It's now down to 7%, and that represents a change of about 750,000 fewer borrowers. This is a percentage of the total active stock of mortgage loans. So we're seeing a significant improvement in the overall share of loans that are seriously delinquent, largely driven, obviously, by improving economic conditions. When we're losing 750,000 jobs a month, obviously, it's very difficult for people to pay their mortgages, and we expect serious delinquency rates to rise dramatically. On the right-hand side axis, we're measuring the REO percentage. Sorry, let's go to the foreclosure percentage first, measured on the left-hand side axis. Historically, through house price run-ups, was a fraction of 1% of mortgaged households were in foreclosure. That makes sense because everybody should have had equity, or most everyone had equity. And you can see the rise during the recession to around 3%, and it's remained relatively flat there, the stock of loans in foreclosure. There's some good news that's coming out of the foreclosure pipeline today, actually, in terms of not all homes going into the foreclosure process necessarily end up as completed foreclosures, and we'll talk about that in a few minutes. Those that do end up in the REO stock, measured here on the right-hand axis, this red line, you can see our REO share was peaked at just under 1% back in 2008, and it's extremely volatile because of a lot of the policy processes that have gone on here. We whittled down a fair amount of the REO in 2009, but it had slowly rose through the 2010 and 2011 period, and is now coming down again. This period through 2009 and 2010 was more policy-driven influences on the movements in the REO stock. Now we're seeing influences are much more market-driven as people are resolving these distressed assets, and as we'll talk about a little bit later, the share of REO sales out in the marketplace is certainly an important thing for the housing market. The overall good news here is fewer serious delinquencies, a lot fewer new people going delinquent, and that's having a good influence on mortgage portfolios. If we break those mortgage portfolios out by the years in which they were originated, this line shows cumulative default rates over time. So if we were to take the red line, the 2007 vintage of loans, so all loans originated in 2007, you can see by the time these loans were 18 months old, just under 8% of all of those loans were already seriously delinquent. And by the time we got to about 2.5 years, about 14% or 15% of those loans were seriously delinquent. The interesting thing that we always notice in what we call vintage curves here is that somewhere around 3 to 4 years, the cumulative default rates flatten off, and basically there are no new defaults. So if loans have survived to about 3 years old, certainly in this 2007 vintage, they survived to about 3 years old, there's very few new delinquencies, so this line no longer rises. Flat line there. So we're not seeing new delinquencies being generated by the 2007 vintage. And the 2006 vintage fared a little bit better. They had some more house price appreciation that kept their rates down. Took them a little bit longer, but they've also flattened out at about 4 years at around the same level of cumulatively about 15% delinquencies. We move to the more recent vintages, the ones that are benefiting from the tightened underwriting standards, requirements of documentation, sustainability of ability to pay the loan, LTV requirements, the 2009, 10, and 11 vintages, and you can see, can't really see 2011, it's tucked way back in here, but they are performing much better for similar age relative to other periods. So at 12 months, the delinquency rate is much, much lower than at 12 months on, say, a 2006 or 2007 loan. Obviously, that's the composition of underwriting has changed, and we have many, many fewer subprime and Alt-A loans in these vintages than we had in these other ones. But all of this speaks to significant improving health in mortgage loan performance, which is obviously the pipeline that precedes everything else. We're going to see a lot fewer delinquencies or foreclosure starts in the next couple of years. Where are these serious delinquent loans distributed? It used to be when we made this chart that most of them were over here on the West Coast, certainly driven in large part in California, Nevada, Arizona, and on the East Coast exception of Florida by the housing bubble. But since then, the migration has been much more back to the East Coast, which is much more industrialized America and economically driven influences. Obviously, Florida is still hanging out because it's dealing with the housing bubble heavily influencing the construction industry in that market, which was very, very big. But all these other markets are where we see much more of the delinquencies coming from. So we've moved from western to southeast and northeastern markets as the primary places where delinquencies are occurring. And in terms of the foreclosure inventory, it's no surprise that the foreclosure rate or the share of foreclosures in total is predominantly in places like Florida, New Jersey, Illinois, foreclosure states. There's a significant, in part, concentration. Many of these states suffered from housing bubbles, but also the ability to work things through is having a significant impact on how many things are in the foreclosure pipeline. Judicial states perform much better, much worse than non-judicial states in terms of clearing the foreclosure inventory. So let's talk a little bit more about all of these distressed assets and the disposition processes for them. First of all, how many distressed assets are there out there? And these numbers range wildly. We use the term shadow inventory. Many refer to shadow inventory as simply meaning those that are 90 or more days delinquent. I showed you that was 7% of the total outstanding stock, so 3 or 4 million in the shadow inventory by that definition. But we're more specific because when I think of the term inventory, I jump to the real estate market and the idea of a home for sale, the inventory of home for sales. So to me, shadow inventory is distressed assets that are going to become an REO home for sale. So very, very specific. And when we take our initial stock of all those folks who are 90 or more days delinquent, we then look at transition or roll rates to say, well, how many of those delinquencies become foreclosures and how many of those foreclosures become ultimately REO assets through a completed foreclosure process. And that's how many are in the shadow inventory. And then even of those who are currently REO, some of them are listed and visible in the marketplace, and so we don't include those. That's roughly half of the REO stock. So when we go through all of that analysis, taking that 90-day delinquency population and haircutting them by those transition rates to estimate how many we believe will ultimately become an REO in the next 18 to 24 months, we get back a number of about 1.6 million today. Now, that's not to say that there won't be new properties entering delinquency and that the flow of shadow inventory will be more, but as a point estimate, we say 1.6 million are likely to become REO sales over the next 1 to 2 years, depending on the timelines in the different markets. The advantage of this analysis is that this style of analysis is that it will be going forward influenced by the foreclosure resolution process. And as loans are resolved in foreclosure through some other means than actually foreclosing on them and putting them in the REO stock, our transition rates will respond and begin to adjust down the shadow inventory as we do more short sales and loan modifications and things like that to resolve what are distressed assets through some other means than an REO sale. So we expect, while the shadow inventory has remained relatively flat over the last year, other data that's leading this in terms of our roll rates and transition information are indicating the shadow inventory may, in fact, over the coming months begin to fall more precipitously, which is good news. That's, of course, one way to resolve the foreclosure inventory is to complete more foreclosures. And, of course, completing those foreclosures is much more easily done in non-judicial versus judicial states. In fact, leading into the housing crisis, when there really weren't that many foreclosures to deal with, there was really not much difference in the number of foreclosures being completed relative to the stock. So we were measuring completed foreclosures per thousands of active loans, which is a sort of a stock measure. So then there was really no difference between judicial and non-judicial states. But then you can see as we went into the crisis, that gap has widened, and now there's a significant difference between the number of completed foreclosures relative to the active loan stock. When you're in a judicial state, we're only doing about 1 per 1,000 loans versus almost twice as fast a pace with 2 per 1,000 loans in the non-judicial space. So, but that also being said, these numbers are down. It's not shown here, but our actual pace of foreclosures is down significantly. We are selling about 8 REO sales for every 10 completed foreclosures. That ratio would roughly be sort of a clearing ratio. If you're somewhere close to or around 1, obviously you're basically selling the stuff out. A completed foreclosure is the entry point into the REO stock, and an REO sale is the exit point. So somewhere close to 1 indicates a balance, or the stock is not growing. Something above 1 would indicate that the stock is shrinking. It's not exactly 1 that's the magic number, unfortunately, because when we look back historically from 2002 through 2005, 6, and 7, you can see the clearing ratio is much lower, and that's because a completed foreclosure doesn't necessarily have to enter the REO stock. It can be bought on the courthouse steps by someone other than the bank holder and have it returned to the REO. So that was much more common when house prices were rising in the early part of the decade. Many foreclosures were proverbially bought by an investor on the courthouse steps. That's not happening nearly to the degree that it was before, and so the ratios are much closer to 1 now. We also note that the distressed REO price discount actually faded during the height of the increase in REO and foreclosure activity, and that's not that the price discount on the REO was declining. It was that the spillover effects to the healthy segments of the market were very strong, and so the healthy market was being drawn down to the REO prices, so that discount is observed to be declining. The fact that that discount is now rising again, we're back up to a discount of about 30% on an REO property, is indicating that it's having less influence on the existing or healthy sales segment of the marketplace. This is a really important thing to consider when you look at REO shares influencing house prices. We basically look at the year-over-year change in the share of sales that are REO versus the year-over-year change in house prices. And you can clearly see in this lower quadrant here, when the year-over-year share is increasing in REOs, house prices decline. And when you get back into these quadrants, this is when the share is going away, house prices increase. And so we had a period, obviously, in 2009, 2008, and a little bit of 2007, where we had a lot of movement down in this direction. And we're now migrating back, most recently, the space back here, where there's much less downward pressure on prices. In fact, the REO share of total sales is coming down very quickly right now. So maybe we should rent all these REOs. After all, it's a $3 trillion market. There's 20 million single-family rental units, which is just over half of all the rental units in the United States. We know that demand for the rental units is rapidly growing, in part because we're foreclosing on people and moving them out of home ownership. And we also know that there's very little institutional investment in scattered site single-family rentals and a big push from a government policy perspective. Let's actually skip in the interest of time. We can see that rental listings growth has flattened. So we've had an increase over the last few years in the number of homes being listed, but it's actually sort of steady stated over about the last year or so in terms of listings. But rental lease signings continue to grow. So we've got the same inventory roughly being put out to market for rental listings against an increasing demand. Of course, what does that mean? Month supply is shrinking. We're down to a seasonally adjusted somewhere around 4% month supply of single-family homes listed for rent relative to rental lease signings. Just as in the single-family market, somewhere below 6 indicates tightness. You can see that that's causing rents to have risen. Again, most recently right here, we have rents rising to an average rent on a single-family home of roughly $1,650 to $1,700 a month. In the context also, we just put house prices over that same period obviously have reduced to a much lower level. So the viability of investing in REO rentals is usually measured through a capitalization rate. That is, how much would be the return if you buy an REO asset and you rent it out at prevailing rental prices. Actually, the overall average is 8%. You can see there's a great amount of variation. We studied 26 different markets in this analysis, and we found that some markets had rental cap rates as high as 12 or 13 or 14%. There were other markets that were much less rich or lucrative, down at 4, 5, and 6%. The overall average is 8. When we look at those markets in the context of a couple of other dimensions, capitalization rate is the Y or vertical axis. The average home price, that is basically an indicator of how much it would cost to purchase an REO asset. On the bottom, the size and color of the bubble is the size of the bubble is the market size, and the color and the color is indicated of the how many distressed assets are out there. So you need a stock of these things. And you can see that certain markets are very interesting to look at. Places like Las Vegas has a large population of cheap homes and a high cap rate. Cleveland is another one that looks very lucrative. Chicago is another one. On the lower end, things that look less attractive from an investment perspective for REO to rental programs is Santa Ana, Los Angeles, Miami. Average home prices are higher, and rents have not accommodated relative to those home prices, so the cap rates are lower. Market like Honolulu, relatively unattractive.
Hey, Dr. Fleming, let's take one more question. How about, will an increased rate of short sales have a significant impact on the number of properties that will become REO? What are your thoughts on that?
Yeah, significant positive impact. Short sale is one of the alternatives to the foreclosure and REO process. And so what usually happens is the home is placed into the foreclosure process by the servicer, but that doesn't mean that they've actually begun executing the paperwork and the process to do the physical foreclosure. It's at that point that things like modifications and short sales are looked at. Short sales as a share of total market sales right now stand at 10%. That's up. It's doubled. It was 5% a couple of years ago. So we have significantly more short sales happening today than in years past, and that those short sales are happening in lieu of an ultimate completed foreclosure and them being part of the REO stock and shadow inventory. So, yes, the more short sales that are executed, the more beneficial that is to the shadow inventory, and the more beneficial that is to the housing market itself, because as the REO analysis showed, it's the price discounting on the REOs that drives house prices down. Short sales only have an average discount of about 10%, as opposed to REOs, which are at 30%. And so even when that sale happens as a distressed sale, it's much less impactful on price levels.
Okay, thank you for that. Let's keep rolling because I know you have some more slides and we're getting short on time. So
sure. So demand for homes is obviously weak. There's I don't think anyone would argue that we've seen a lot more homes turned over and demand for housing purchases instead of refinance mortgages in years past. And a lot of that is, in large part, there's a distressed asset share. There's new and first-time home buyers are less willing to jump into the market at the moment. Household formation is down in the first-time home buyer demographic age groups that would be buying, and these are all factors. Economic confidence is another factor. If you're not confident in your economic future, you would be less likely, certainly, to jump into the market and buy. But the biggest factor is actually more related to who buyers are. And if you notice here, the largest bucket no matter where you are in terms of time, is always the existing home buyer. And so that most existing homeowners become the new buyers. And so you have this supply and demand turnover effect. That's primarily driven by negative equity. That is that most of the folks who currently own homes, who would be your purchasers, can't sell their home. And so they're not entering their house on the sell side of the market, and neither are they demanding to buy a home on the buy side of the market. We estimate right now about 23% or 11.1 million households are underwater. But if you consider the homeowner today who would need to want to buy a home tomorrow and get a loan to buy that home, he's going to have 20% equity to put down on that new home. Even if he were buying the home of a similar value to the one he's selling, he's having to transfer that equity from the home he owns to the home he buys. If we look at the 80% mark and everybody who's at higher than 80% or underwater, that's actually 45% of all mortgaged homes. So a vast majority of homeowners today don't have sufficient equity to buy a home if they're required to put 80% down. That's partly why we see a fair amount of popularity in things like the FHA program, which have lower requirements on the down payments as opposed to the traditional conforming loan space. But that negative equity and under-equitied issue is a significant problem for home demand because much home demand is driven by the turnover of existing homeowners. Not only is it just a little bit of negative equity that might be repaired with a couple of years of house price growth or paying off your loan, the unfortunate truth is that this negative equity is often deep from places like Las Vegas, for example. More than half of all folks who are underwater by 25% or more. That's not something that gets recovered from quickly. I do expect that it is something that we will eventually recover from, but negative equity will be a drag on the turnover and the demand in the housing market for a number of years to come, obviously differentially paced by improvements in different markets over time. That being said, all is not lost because, as I said, while demand is weak, the supply of inventory is also low. So we're actually experiencing quite balanced markets at very low physical levels. When we measure month supply, we can see that actually we're down to a month supply of 6. It's quite healthy. It was much worse back in 2008. We had 14 months supply. Of course, that's why house prices were falling so dramatically. It's not the case anymore. We're actually, even given the weak demand, we have relatively low levels of inventory. On a national basis, the month supply is very healthy at 6, and there are many markets where we're actually even tight and have less than 6 months supply. Places like Phoenix, for example, are often talked about, which would actually push prices up. And after all, prices are a reflection of all of this, and you can see, ignoring the volatility of our red line, which is month-over-month growth, you can see we had month-over-month growth in prices seasonally in our expected spring-summer buying seasons in 2009, again in 2010, and again in 2011. The only problem was the one step taken forward in those months was also in the off-season times we would take 2 steps backwards. So the dark blue line right here representing year-over-year growth has remained negative but for briefly in 2010 due to the tax credit and faded again. The good news is this line is actually slowly creeping back up towards zero, and we do expect that year-over-year growth will go positive. We're already seeing month-over-month growth in our overall index is increasing, and we have models that look at pending prices from new listings activity in the MLS, which is really the leading indicator of where price levels are going, and those models are saying that our indexes in the March, April, and May months will push positive in month-over-month growth. So, as much of the market has talked about in better spring season this year, prices are actually responding to that, and we believe that even in April already, prices have actually risen on a month-over-month basis nationally, obviously driven by a diverse blend geographically, but there are many more markets increasing now than before, and the overall share increasing relative to those decreasing is winning the day with positive upward national movements. You can see at one point over 90%, it's actually 95% of the 900 CBSAs that we track in our house price indexes, over 95% of them back in 2008 were experiencing house price declines. So the amount of decline was very, very geographically diverse. It was practically everywhere. Obviously, the magnitude was different depending on where you were, but it was very diverse. We've now come significantly off that. We're only down to about 60%, and a lot of those are smaller markets. There are some major markets now that are increasing in month-over-month growth rates by our estimates. And then one last slide to put all this in context. Just like in the labor markets, what's interesting to understand the cyclicality, the timing, and the depth of the housing recessions. These are all housing recessions that were regional, because that's really all we had historically prior to this, the national housing recession we just had. And regional recessions would typically, from the peak of house prices indexed to 100, would remove about 20% cumulatively, anywhere from 10 to 20% depending on what recession you're in. They would all take roughly 4 to 5 years to get there to trough out, and they would roughly take another 4 to 5 years to peak again, depending upon where you are, to get back to those peaks. So housing recessions have always had this profile of a very U-shaped and long cycle that would run anywhere from 8 to 10 years. Most recently, this is the national line. Cumulatively, you can see we've bounced our way down. We've lost about 35% cumulatively today. It's taken us almost 6 years to get there. So it's maybe a little bit longer, but timing-wise not too far off what our traditional cycle length would be to trough. We've included Nevada and California just as examples. Nevada's actually knocked over 40% off its prices in over 60% off price levels, in California 40. And those turning points would mean that we have much longer cycle times. If you sort of trend these lines back out, it's going to take well over 10 years to go through that cycle. But I would argue, obviously, that this price point that we were at peak was never really sustainable in the first place. Thank you.
Thank you, Mark. Very informative as usual. We have some more time for some questions, and so let's get to it. So one question here is that are there markets that are recovering faster than others?
Yes.
And I guess are there any differences between those that are recovering versus those that may not be?
Yeah, there's certainly there are. We look at for recovering or improving markets, we actually look across a couple of different dimensions, not just prices. Obviously, we want to look at prices improving. But that's really the final reflection. We focus more on the inventory levels, and so markets like Phoenix are improving from an inventory level perspective. We look at the share of serious delinquencies, or the serious delinquency rate in those markets. We want to see those delinquency rates going down, so we don't, we're looking sort of at the early stages of future distressed stock, and the REO shares. And so you have, generally, to characterize it without talking through the list, markets that are most improving right now tend to be non-judicial, so they're addressing their shadow inventory and their foreclosure portfolios more quickly and aggressively. They tend to have gone through the housing bubble, so they're recovering more quickly out of that housing bubble because of investor demand for these assets. You're talking about the Sand States in California, and even to some extent some markets in Florida, as well as markets that had avoided the distress altogether. Those that are not improving or dragging things down still are markets that tend to be judicial states with high foreclosure portfolios, large REO stocks, large REO shares with big discounts and long timelines. What I say there, pretty much everyone's not too surprised about, but that's really how it's falling out right now. At a national level, we're seeing improvements on the positive side, which means that the winners are on size and share, beating the overall losers now, which is a good sign. Interesting.
Okay. I've got two questions here. I'm going to save one for the last because I think it's a good one to close with. But let's go with why do prices keep falling, or why do you think prices keep falling after sales volume has increased?
Right, it's tricky. So you have to understand when you say prices keep falling, I'll assume you're referring to the house price indexes that are published on a monthly basis and reported in the news. In particular, we have one, and then Case-Shiller as well, for example. And they are reporting year-over-year growth rates. In other words, our price is up or down by X% relative to the same month a year ago. And So part of it has to do with what was going on the year ago. If you had a spike up in a spring buying season that was stronger last year than this year, you might have a year-over-year negative growth rate if you could imagine sort of comparing price levels at 2 different points a year apart. It's a bit hard to see it that way, that sometimes the negative numbers are actually only negative because you had a really good spring season, for example, a year ago. But more importantly, the key here is that house price indexes and house prices lag all of these things. It's the last thing to show it, basically. And that's because it's going to be a reflection of that supply and demand dynamic. We know from research that when the month supply, as measured in the MLS systems of inventory of homes for sale relative to the pace of how many homes are selling, goes below 6, that pressure begins to mount on prices, and it takes a couple of months to actually show up. In fact, we'll be talking about it in our next market pulse. We're building a pending house price index value that basically says, well, I see what my house price index is saying about closings in March, but I have new listings data from, say, April and May, and that data can inform me about what my house price index will say, or I can estimate a pending index value. And for example, in this month, all of the good home sales activity that we've been seeing over the last couple of months is showing up in better pricing and listings, which the model is saying will show up as better in terms of month-over-month growth rates in the index. So it's the last thing to show it. We're introducing things now to sort of get over that hump and sort of show how that correlation works and what we believe in a more timely fashion the markets are doing from a pricing perspective.
Got it. Actually, we're going to take a couple more questions, okay? You're good with that?
Yeah.
All right, here we go. So what effect, if any, do you see the expiration of the Mortgage Debt Relief Act having on the current real estate market?
Well, I'll take it in a broader context. The mortgages or mortgage credit, or to say it more broadly, the ability to leverage your income to buy a home and get a mortgage, is at historically great levels, right? 4% interest rates are unheard of historically. Affordability, which is the combination of your ability to leverage whatever income you have, which honestly hasn't grown that much, with such a low interest rate against house prices that in many markets have come down so much, is placing affordability at these amazing, amazing levels. And so the problem that we face is that mortgage credit is going to become more expensive, whether it's through changes to the tax beneficial treatment of mortgage interest, whether it's changes to addressing credit risk and the fact that it's likely underpriced at the moment in mortgage rates for conforming loans, the fact that honestly the cost of the regulatory compliance burdens that will occur on the servicing industry or as a result of all the new regulation are increasing. It costs more to service a loan today, regardless of whether it's performing or not, just because of the compliance burden. It will cost more to service a loan, and so that cost will have to be borne. So mortgage credit will get more expensive. There's no doubt about that, for a variety of reasons. There's the tax beneficial treatment, strong lobbying. There's very, very strong lobbying against that. That's really a political question. But in the long run, for a variety of reasons, mortgages will get more expensive. In the current context, that's actually not that big of a deal because the affordability levels are still so high, and ultimately that's really what buyers are looking at. It's not whether or not I can get a certain rate, but how much that rate allows me to leverage my income and how much house I can buy. And you can buy a lot of house today with the current rates and your current income levels. And even if rates go up some, which we all expect them to do, you'll still have likely a high degree of affordability over the next couple of years.
Okay, here's a final question. It's a big one, okay? Have we hit the bottom? And will it stick?
Yes. And then that was on my one hand, and then on my other hand, I have to say, well, we thought we hit the bottom a couple of times before. Let me see if I can quickly show that to everybody. Let's see if I have a better one. Yeah, let's leave it here. We thought we hit the bottom when house prices peaked actually it wasn't here in 2009, but here in 2010, year-over-year growth rates went positive. We were coming out through the homebuyer tax credit, was having a very strong influence, pulling forward a lot of demand. The housing market responded, house prices stabilized. And when we usually talk about hitting bottom, we're sort of referring to pricing levels stabilizing. So we thought, all is good. The problem with that was that the tax credit expired and the demand faded significantly. It was sort of akin to a pretty strong hangover. All the demand disappeared and house prices continued to fall. We again saw actually some stabilization in the beginning of 2011 that seemed to be more economically fundamentally driven, but then our economy sort of fell off the rails a little bit with the European debt crisis, the Japanese earthquakes, and our own debt ceiling debate. And that sort of sent, the demand faded, consumer confidence crashed, everybody stopped wanting to buy, demand went down, prices declined again. So I guess I'm saying, yes, we could have called the bottom twice before. Here we are again in terms of the profile of house prices. Hey, they're turning up again. This is a good sign. Yes, we have a bottom. I pause simply because I feel like, well, if the economy stays on relatively good rails and gets close to long-term trend growth in the 2s to 2.5 range, if consumer confidence maintains or improves over the coming months, and we don't have any surprise shocks like another natural disaster somewhere that influences supply chains or some other major events like that, then yes, this one really might stick, but you never know when some of these things might happen. So I am hopeful that this is a bottom, and the longer we go now without any major shock, the more strength this recovery will have, and the more it will be able to sustain without significant detrimental impact any shock that might come. So time is one of our most helpful forces at the moment as we try and get on to an economic recovery in the housing market.
Okay, well, we'll look forward to, I guess, riding that out. But we're up against the hour, and I think that's going to conclude our presentation today. I want to thank you again, Dr. Fleming. Very informative. And just to remind everybody, the webinar, once more, will be available within 3 business days for future viewing. And have a great rest of your day. Thank you for joining us today.